What if every price you see on your screen is a lie? Right now, at this exact moment, someone in Shanghai is paying $101 for 1 ounce of silver, physical silver, metal you can hold in your hand. Meanwhile, someone in New York is being told that same ounce is worth $89. That's a $12 difference. Not a small premium, not a shipping cost. A $12 confession that Western paper markets have completely lost touch with physical reality. This premium has been growing for weeks. It widened during Wednesday's CME trading halt. It expanded while Western silver crashed. And nobody in mainstream financial media is asking the most obvious question. Why does real silver cost $12 more when actual buyers are involved? Hi, I'm Roxanne. Before we go any further, let me be crystal clear about something. I sell nothing. Not courses, not premium memberships, not signal groups, not newsletters behind paywalls. Zero. What you're about to see is raw data, publicly verifiable information, and analysis you can check yourself. No hidden agendas, no products to push, just the numbers that most financial media won't touch, because explaining them honestly would expose how broken the silver market really is. Over the next few minutes, I'm going to walk you through exactly what the Shanghai premium reveals, why it keeps growing instead of closing, and what it means for the silver market in the next 48 hours as we head into March settlement. Every claim I make can be verified through exchange data, vault reports, and official sources. By the end, you'll understand why this $12 gap is the most important signal in precious metals right now. Let's start with the numbers, because they tell a story that no amount of financial spin can hide. Shanghai spot silver closed at $101 per ounce on February 25th. Shanghai Futures Exchange silver sits at $106. Western spot silver trades at $89. That's a $12 premium for spot, and a $17 premium if you compare Shanghai Futures to Western spot. Now, under normal market conditions, premiums between exchanges exist. They're usually tiny, maybe 25 to 50 cents, and they reflect transportation costs, local demand variations, or temporary arbitrage opportunities that traders close within hours or days. A $12 premium that persists for weeks and widens during Western price crashes is not normal. It's a structural dislocation. It means the price discovery mechanism has fractured into two separate realities. On one side, you have the paper market. COMEX in New York, LBMA in London. These are futures exchanges where contracts representing millions of ounces of silver trade every day. The ratio of paper contracts to actual physical silver available for delivery can reach 300 to 1 or higher. It's a market built on leverage, speculation, and the assumption that most contracts will never demand physical delivery. On the other side, you have the physical market. Shanghai Gold Exchange in China, where industrial buyers, manufacturers, and investors pay cash for real metal. The delivery rate approaches 100%. When you buy silver in Shanghai, you're taking possession. You're not rolling a contract forward. You're not settling in cash. You're taking bars out of the vault. And right now, the physical market is screaming that Western paper prices are fiction. Here's what should happen when a premium like this appears. Arbitrage traders should immediately step in. They'd buy silver in New York at $89, ship it to Shanghai, and sell it at $101. That's a $12 profit per ounce, minus shipping and insurance costs. Easy money. Except it's not happening. The premium isn't closing. In fact, it's widening. Why? Because there isn't enough physical silver in Western vaults to support the arbitrage at scale. When traders try to source large quantities of actual metal to ship east, they run into the same problem. COMEX registered inventory is at 87 million ounces and falling daily. LBMA vaults are experiencing similar stress, with freely circulating inventory estimated below 4,000 metric tons. The metal that does exist in Western vaults is either already spoken for, allocated to ETFs, pledged against existing contracts, or held by institutions who won't sell at current prices. Or it's in the eligible category, meaning it's in the vault but not designated for delivery. So the arbitrage opportunity that should close the gap can't function at scale. The physical supply that would need to flow from west to east to equalize prices doesn't exist in sufficient quantity. The premium persists because the paper price in the West is artificially low relative to what actual buyers are willing to pay for physical metal. Now let's talk about what happened on Wednesday, February 25th, because this is where the Shanghai premium reveals its true significance. 12:15 p.m. Central Time. CME Group halts all metals trading. Silver is at $91 in New York, building momentum toward $92 resistance. The halt lasts 90 to 100 minutes. When trading resumes at 1:45 p.m., silver drops $3 in minutes, from $91 straight down to $88. No pause, no bounce, just pure selling pressure. Now here's what should have happened to the Shanghai premium. If the CME halt and subsequent price drop reflected genuine changes in silver's fundamental value, the Shanghai premium should have narrowed or collapsed. Chinese buyers should have backed off. The gap should have closed. Instead, the premium widened. Shanghai didn't drop when New York crashed. The premium went from $10 to $12 during Western weakness. Physical buyers in Asia looked at the Western price crash and said, "That's not real. That's paper manipulation. We're still paying $101. That behavior tells you everything. The market where actual metal changes hands ignored the Western paper price collapse. The premium expanded because physical buyers recognized the Wednesday crash for what it was, a reset of paper positioning that had nothing to do with physical supply and demand. Shanghai isn't alone. This is a global pattern. Japan saw premiums on secondary market platforms like Mercari surge to 60% in late 2025. 60%! That means individual Japanese buyers were paying $140 for silver when Western spot was at $88. That's not a mistake. That's not irrational behavior. That's what happens when physical metal is genuinely scarce and buyers know the paper price is divorced from reality. India is experiencing similar stress. In October 2025, major Indian mutual funds, including Tata, Kotak, SBI, and UTI, temporarily suspended new lump sum subscriptions in silver ETFs. The reason? High physical premiums and limited availability of LBMA-certified bars. These are massive institutional funds managing billions of dollars, and they couldn't source enough physical silver to meet investor demand at reasonable premiums. Even in London, the heart of Western silver trading, lease rates exploded. Under normal conditions, one-month silver lease rates hover around 0.3% to 0.5%. By January 2026, rates hit 8%. In October 2025, intraday spikes reached 39%. A lease rate is what you pay to borrow physical silver. When someone is willing to pay 8% or 39% annualized just to get their hands on metal for short-term delivery, it means there isn't enough available silver to meet immediate demand. It means the vaults are tight, the float is shrinking, and physical scarcity is real. Now let's talk about enforcement, because this is where Eastern exchanges are sending a very clear signal. The Shanghai Futures Exchange suspended 25 trading groups in February 2026 alone. 25 accounts in 1 month for violating position limits and breaching exchange trading rules. You don't suspend 25 accounts in 30 days as routine compliance housekeeping. Exchanges enforce position limits aggressively when concentrated positioning threatens systemic stability. When too many traders are piled into the same side of the trade at dangerous leverage levels, exchanges step in to prevent cascading failures. Shanghai is telling the world that positioning in silver futures has reached extremes that require intervention. And they're doing it publicly, with documented suspension notices that anyone can verify. Meanwhile, in the West, CME experiences its second major trading halt in 3 weeks, but provides no detailed explanation beyond technical issues. No transparency, no post-mortem, just 2 words and a reopening that conveniently reset momentum at a critical moment. The contrast is striking. Eastern exchanges are openly enforcing against concentrated risk. Western exchanges are going dark at critical moments without explanation. Let me show you the vault data, because this is why the Shanghai premium isn't a temporary aberration. It's the new normal until Western inventory is replenished or paper prices rise dramatically. COMEX registered silver stands at 87 million ounces as of February 25th. That's down from 168 million ounces in October 2025. a 38% decline in 4 months. On Tuesday, February 24th alone, over 2 million ounces left registered status. Asahi withdrew 1.55 million ounces. HSBC pulled 647,000 ounces. JP Morgan withdrew 374,000 ounces. Every single day, metal walks out the door. Now cross that against open interest. March 2026 silver futures represent approximately 500 million ounces of paper contracts. That's nearly 6 ounces of paper claims for every 1 ounce of deliverable metal. In February, which isn't even a major delivery month, the delivery rate approached 98%. Between 33 and 49 million ounces were delivered in the first 2 weeks. Historically, February sees 1 to 5 million ounces. This year, it's 10 times higher. This is why the Shanghai premium exists and why it can't close through arbitrage. There isn't enough Western metal available to ship east at scale. The registered inventory that backs Western paper prices is draining, and nothing is replacing it. London is facing the same crisis from a different angle. According to multiple industry sources tracking LBMA vault data, freely circulating silver inventory in London has fallen below 4,000 metric tons. That's roughly 128 million ounces. And that's the total freely circulating supply. The metal not already allocated to ETFs, not pledged against existing contracts, not held in allocated accounts. For context, London is the world's largest over-the-counter precious metals market. LBMA silver clearing volumes regularly exceed 200 million ounces per day in notional value. When your freely circulating inventory is 128 million ounces and daily clearing volumes are 200 million, you're operating a system where paper claims dramatically exceed available physical supply. This is why London lease rates spiked to 8% and touched 39% intraday. Banks that normally lend silver to refiners, mints, and industrial users can't access enough metal to meet demand. The inventory is locked up, allocated, or simply not available. And when London is tight and New York is tight simultaneously, Shanghai's premium makes perfect sense. Eastern buyers know Western vaults are under stress. They know delivery delays are increasing. They know lease rates are screaming scarcity. So they pay $101 in Shanghai for metal they can take possession of immediately, rather than $89 in New York for a paper contract that might settle in cash or face delivery delays. Yesterday, March silver contracts rolled forward by 71 million ounces. That's the single largest one-day roll observed in this cycle. On the surface, it looks like immediate delivery pressure has been relieved. Shorts facing March obligations bought themselves time by pushing those obligations into May and July. But here's what didn't happen. No new metal entered COMEX vaults to replace what's been leaving. The roll moved obligations forward in time. It didn't create new supply. It didn't bring metal back into registered status. It didn't address the fundamental imbalance between paper promises and physical availability. The 71 million ounce roll is a temporary pressure valve. It defers the crisis, it doesn't resolve it. And every week that registered inventory continues declining without replenishment, the structural tension builds for the next settlement cycle. Now layer in a supply crisis that's getting worse, not better. Mexico produces over 200 million ounces of silver per year, making it the largest silver-producing nation on Earth. It supplies 50% of all silver imported into the United States. Half. In the past week, cartel-related violence has escalated in key mining regions. 10 mining workers were abducted. 3 were found dead. The incident has triggered immediate operational consequences. Mining companies are struggling to attract employees in high-risk zones. Security costs have surged. Transportation of ore and refined metal faces active disruption. The United States declared silver a critical mineral in 2025 for the first time in history. The designation reflects documented demand from AI infrastructure, defense applications, and the green energy transition, all of which require silver with no current substitute. When the dominant global supplier faces active security threats, while the market is already in its 5th consecutive year of supply deficit, prices don't absorb that risk neutrally. They reprice violently. And they reprice first in the physical market, where actual buyers need actual metal. This is another reason the Shanghai premium exists and persists. Eastern industrial buyers can't wait for Mexico's security situation to stabilize. They can't risk supply chain disruptions. So they pay premiums now to secure inventory before conditions deteriorate further. Here's a data point that connects everything we've discussed. COMEX open interest in silver is declining. Money is leaving the futures market. At the same time, SLV, the largest silver-backed ETF, is recording consistent daily inflows. This has been happening for weeks. That's not random capital rotation. That's deliberate risk repositioning. Sophisticated traders are choosing to pay ETF management fees and accept tracking error rather than hold futures contracts that theoretically guarantee delivery. Why? Because they're concerned about counterparty risk. They're concerned that when they stand for delivery, they might face cash settlement against their wishes, delivery delays, or force majeure declarations. You don't abandon the more capital-efficient instrument, futures, for the less efficient one, ETFs, unless you have doubts about whether the efficient instrument will actually perform its core function. When institutional money starts preferring physical-backed ETFs over direct futures exposure, the futures market has a trust problem. And trust problems in leveraged derivative markets don't heal gradually. They rupture suddenly. Let me show you something from the gold market that reinforces everything we're seeing in silver. The February gold contract, which by every normal measure of settlement behavior should be almost entirely closed by now, still shows 4,000 open contracts. That represents 12 metric tons of gold worth approximately $2 billion at current prices. February is functionally over. Those contracts opened at the beginning of the month. Standard practice clears or rolls the vast majority of delivery month contracts well before the final days. Having 4,000 still open this late is not a paperwork backlog. It's an indicator that someone, somewhere in the clearing chain, is struggling to source 12 tons of physical gold against contractual obligations. If gold, the deeper, more liquid market with larger vaults and more established clearing mechanisms, is exhibiting delivery strain, what does that tell you about silver? Where registered inventory is smaller, industrial demand is inelastic, and the largest producer faces active security disruptions. It tells you the entire precious metals complex is under stress. And when stress appears simultaneously in gold, silver, London, New York, and Shanghai, you're not looking at isolated incidents. You're looking at a systemic condition. Let me walk you through why the Shanghai premium is more likely to expand than contract in the coming weeks. First, March settlement begins in 48 hours. If delivery demand continues at February's 98% rate, COMEX will face requests for 100 to 125 million ounces against 87 million available. That's a shortfall that will either force cash settlements, trigger exchange intervention through margin hikes, or result in delivery delays that further damage confidence in Western paper markets. Second, Mexico's supply situation is deteriorating, not stabilizing. Each week of production disruption is metal that won't enter global supply chains. Industrial users who depend on steady silver flows will pay premiums to secure inventory from alternative sources, primarily Eastern markets where metal is actually available. Third, the ETF migration is accelerating. As more capital moves from futures to physical-backed vehicles, it removes metal from circulation permanently. ETF metal sits in vaults backing shares. It doesn't flow back into the lending pool. It doesn't become available for industrial use. Every ounce that enters an ETF is an ounce subtracted from the float. Fourth, lease rates remain elevated. As long as borrowing costs stay at 8% versus normal levels of 0.3%, the economics of refining, minting, and industrial processing are strained. Refiners who normally borrow metal, process it, and return it can't afford 8% lease rates. Production of coins, bars, and industrial products slows. Supply tightens further. And fifth, China is not easing. The 25 Shanghai suspensions in February signal that Chinese regulators see positioning that concerns them. They're not loosening position limits. They're enforcing more aggressively. That means concentrated demand from Chinese buyers isn't going away. It's being managed, but not eliminated. All 5 of these factors push in the same direction: tighter Western supply, stronger Eastern demand, and wider premiums. Here's the fundamental question the Shanghai Premium forces us to confront. Which market is discovering the real price of silver? Is it COMEX, where 500 million ounces of paper contracts trade against 87 million ounces of deliverable metal, where the delivery rate in a non-major month just hit 98%, and where the exchange has halted trading twice in 3 weeks? Or is it Shanghai, where delivery rates approach 100%, where physical metal actually changes hands, where premiums have been expanding for months, and where regulators are actively managing concentrated positioning because demand is so intense it threatens stability? The answer should be obvious. The market where actual buyers take actual possession is discovering the real price. The market where paper promises outnumber physical metal by 6 to 1 is discovering the price that institutions want you to see. And right now, those two prices are $12 apart. That gap is a confession. It's an admission that Western paper markets are divorced from physical reality. And every day that gap persists or widens, confidence in paper pricing erodes further. Let me present the bearish argument. The Shanghai Premium could narrow or collapse if any of these conditions change. First, if COMEX registered inventory suddenly increases. If eligible metal converts to registered at scale, or if new metal enters the vaults in meaningful quantity, delivery pressure eases and the premium could shrink. Second, if Chinese demand moderates. If industrial users in China slow purchases, if economic conditions weaken, or if government policies shift, Eastern buying pressure could decrease and the premium would narrow. Third, if Mexico's security situation stabilizes rapidly. If cartel violence decreases, if mining operations return to normal, and if supply disruptions resolve, global supply would improve and premiums would compress. Fourth, if the 71 million ounce roll actually works. If March settlement completes smoothly, if deliveries stay below registered inventory, and if the system demonstrates it can handle current demand without stress, confidence in paper markets would improve and premiums would normalize. And fifth, if exchange intervention through margin hikes or position limits successfully reduces speculative demand. If CME raises margin requirements high enough to force leveraged longs out of the market, prices could fall and premiums could narrow. Every single one of these scenarios is possible. The bearish case is not irrational. It's mechanically coherent. But here's why the data suggests the bearish case is incomplete. Registered inventory has been declining for 4 months without meaningful replenishment. Chinese demand is driven by structural factors: green energy transition, strategic stockpiling, industrial requirements, not speculative enthusiasm that evaporates quickly. Mexico's security issues are worsening, not improving. February's 98% delivery rate suggests the system is already under stress before March even begins. And exchange intervention through halts and margin hikes has historically only delayed price movements, not prevented them. The bearish case requires multiple conditions to improve simultaneously. The bullish case only requires conditions to remain as they are. We're now 48 hours from March 1st notice day. Here's exactly what to watch. First, COMEX registered silver inventory. If it continues falling session by session without new metal entering, the structural thesis strengthens. If new metal suddenly appears in registered status, the immediate pressure eases. Second, the Shanghai Premium. If it holds at $12 or widens during Western trading hours, it confirms that physical buyers are ignoring paper price action. If it narrows sharply, it suggests Eastern demand is moderating. Third, March delivery notices. When first notice day arrives on February 27th, we'll see how many contract holders actually stand for delivery. If the rate matches February's 98%, COMEX faces a crisis. If it drops to historical norms of 10% to 20%, the immediate squeeze scenario fades. Fourth, silver lease rates. If they remain elevated at 8% or spike higher, it confirms physical tightness. If they collapse back towards 0.3%, it suggests the stress was temporary. Fifth, any additional CME disruptions. If metals trading experiences another halt, delay, or technical issue in the next 48 hours, the pattern becomes undeniable. If trading operates smoothly, Wednesday's halt looks more like a genuine technical failure. And sixth, price action. If silver holds $89 as support and tests $92 again, despite the Wednesday reset, It tells you buying pressure is strong enough to absorb exchange intervention. If it breaks below $88 and continues declining, it suggests the halt successfully broke momentum. Here's what we know for certain. Shanghai is paying $12 more for silver than New York. That premium has persisted for weeks and widened during Western price weakness. The premium exists because Western registered inventory has fallen 38% in 4 months, because delivery rates hit 98% in a non-major month, because lease rates are at 8% versus normal 0.3%, and because physical buyers know paper markets are under stress. The arbitrage that should close the premium isn't working because there isn't enough Western metal to ship east at scale. The 71 million ounce roll deferred March delivery pressure, but created zero new supply. Mexico's security crisis is worsening. ETF inflows are accelerating as money flees futures for physical exposure. Shanghai suspended 25 trading groups in February for concentrated positioning, and COMEX has halted trading twice in 3 weeks. The $12 Shanghai premium is not a data point. It's a verdict. It's the physical market ruling that Western paper prices are fiction. We're 48 hours from March settlement. The next 2 days will reveal whether the system can handle delivery demand that's running 10 times higher than historical norms, or whether the cracks we've been documenting for weeks finally break open. This is financial education, not investment advice. Every claim in this video can be verified through exchange data, vault reports, and official sources. Check the numbers yourself. The Shanghai premium is published daily. COMEX inventory is updated every trading session. Lease rates are public. Enforcement actions are documented. If this changes how you see the silver market, share it with someone who still believes the paper price is the final word. Drop a comment. Hit subscribe for updates as March settlement unfolds. The data doesn't lie. The premium is real, and it's telling you exactly what's coming.